How does the Indian banking system work? Indian banking system is the lifeline of the economy. All the banks in India are governed by the Reserve Bank of India or the RBI. Although there are some traditional ways of lending that are prevalent in areas where there are no banks, this lesson focuses on explaining the functioning of the Indian banking system. The Indian banking system is divided into two parts, organized and unorganized. Organized banking system refers to the Indian banking system that comes under the influence, management of the RBI. It includes all the organizations that come under the purview of the Reserve Bank of India. The organized banking system comprises commercial banks, cooperative banks, development banks, and financial institutions like mutual funds and hire companies. Commercial banks are the banks which have been established under the Indian Companies Act of 1913. The first commercial bank of India was the Bank of Hindustan. Right now, the banks are categorized into public sector banks, private sector banks, and regional rural banks. Let us know about each of them in detail. Let's start with public sector banks. These banks are owned, operated, and managed by the government. State Bank of India is the largest public sector bank. It has 19 nationalized banks under it, like the Bank of Baroda, Punjab National Bank, Canara Bank, Bank of India. Next are the regional rural banks. Sometimes some public sector banks sponsor the regional rural banks. They are scheduled commercial banks. The main objective behind setting up these banks was to provide credit to people in rural areas such as laborers, artisans, etc. There are 56 RRB in India as per 31st March 2017. Next are the private sector banks, which are managed by private people. As per the data released in March 2017, there were 23 private banks in India. The common and famous names in India are HDFC Bank, ICICI, Kotak Mahindra Bank, Axis, Yes Bank, etc. These banks are known as new generation tech-savvy banks. Several foreign banks in India are wholly owned branches of the banks owned internationally. In 2017, there were a total of 44 foreign banks in India. Some of the examples of the foreign banks are American Express, Citibank, Standard Chartered Bank. These banks have brought newer techniques and more competition that has made the Indian banking scenario more competitive. Lastly, there are development banks that are created to give priority to the development objectives. They are not like the usual commercial banks as they do not accept deposits and offer short-term loans, but instead they offer medium and long-term finance options. These banks offer private enterprises long-term loans by taking up their shares and debentures. Some examples of development banks are Industrial Development Bank of India, Industrial Finance Corporation of India, Small Industrial Development of India. After learning about the organized sector, let us move to the unorganized banking sector in India. So, when we say the word unorganized, this can be related that the government has not organized this banking sector. Unorganized banking is not governed or managed by the RBI. The chit funds and the nidhis are the most common examples. Chit fund is defined as per Section 2B of the Chit Fund Act 1982. A chit fund is a rotating savings and agreement among direct persons to subscribe to a certain sum of money for a specified time. Chit funds are known by different names such as microfinance organizations, chitti, kuri, chit. Chit fund helps in collecting the small savings of the individuals, which turns into a big amount. Nidhis are more commonly like a mutual benefit scheme where group members contribute to get a lump sum amount and earn interest. Both Nidhis and chit funds are common in South India. Apart from these, there are Marwari Kayas, Gujarati Shroffs, Sahukars, Multani Shroffs, etc., who offer loans. These are money lenders who operate using their own money in small rural areas for offering credit to laborers, farmers, and artisans who are far away from the reach of the banks. Let us do a quick recap of the important points learnt in the video.
We are familiar with banks and post offices. They provide us with facilities that allow us to save our money as well as invest it to earn more. We deposit money in a bank or a post office for safety and to earn interest on our savings. We withdraw money as per our needs. Thus, a bank is a financial institution where individuals or businesses can deposit their money for safekeeping and can withdraw it as per their needs. The deposited money is invested by the banks, and the deposit also earns interest for the customer. However, to deposit or withdraw money to a bank, we need to hold an account with that particular bank. Based on our use, we can open different types of accounts with a bank. The main types are savings accounts, recurring deposit accounts, term or fixed deposit accounts, and no-frills accounts. A savings account is the most commonly used type of bank account by individuals. This type of account promotes the habit of saving for future use. In a savings account, an individual can deposit sums of money any number of times and shall earn the applicable interest on his deposits. A certain minimum balance of money may need to be maintained in one's account. The number of withdrawals is sometimes restricted over a certain period of time. There are two types of savings accounts. The first is an individual or single account. Such an account can be held by an adult individual or even a minor who has attained the age of 10 years. Till a minor account holder has not reached the age of 10 years, a guardian may operate the account on behalf of the minor. The second type of savings account is a joint account. Such an account may be jointly operated by two or more adults. Each of the joint account holders can individually operate the account. A recurring deposit account is for individuals who wish to deposit a specific amount of money every month for a fixed period at a fixed rate of interest. A term or a fixed deposit account is used when an individual wants to deposit a certain amount of money for a fixed period of time at a fixed rate of interest. The amount deposited in an FD may only be withdrawn after its maturity date, which is the date when its period of deposit expires. The rates of interest offered for fixed deposits are relatively higher than the normal rates. A no-frills account is a basic type of account intended for those who prefer to maintain either a low or zero minimum balance. The initial deposit required for such an account is also very low or sometimes zero. Such an account is beneficial to the section of people who may not be able to afford maintaining a high balance in their accounts. There are three ways to withdraw money from a bank. We may use a check, a withdrawal form, or an ATM debit card. A check needs to be filled with the name of the party that is withdrawing the money, the amount of money to be withdrawn, the account holder's signature, and the date of issue. Such a duly written check can be used at the bank to withdraw money. Note that the party withdrawing money may either be the account holder himself or anyone whom the account holder owes money. Withdrawal forms are available at the bank. To withdraw money from one's account, the account holder just needs to fill in details such as his name, account number, and the amount of money to be withdrawn. The same is then signed by the account holder and presented at the bank by him to withdraw money. The modern and most preferred method of withdrawing money these days is by the use of ATM or debit cards. Such a card is inserted in an automated teller machine or ATM, and after proper authentication of the user, money is dispensed by the machine. Debit cards are also used these days while shopping to make direct payment to the vendor or also to pay bills and make other payments through the internet. Let's take a closer look at the operation of checks. Banks issue checkbooks to account holders against a requisition form or request form duly signed by the account holder. The requisite is that the account holder has to maintain a minimum balance in his or her account to avail of this facility. We already saw that a check may be used by an account holder to withdraw money, but very importantly, checks are mostly used to make payments to other parties. The parties connected with a check are the drawer, the drawee, and the payee. The drawer is the account holder himself who wants to withdraw money through the check. The drawee is the bank on whom the check is drawn. It is the bank that pays the money. And the payee is the person or organization to whom the check amount has to be paid. The bank usually asks the payee to put their signature on the backside of the check. Note that in India, a check is valid for 3 months from its date of issue. After that, it becomes unusable. Such a check is also called a stale check or an outdated check. Checks are broadly classified as bearer checks and crossed checks. A bearer check can be encashed by any person who possesses the check, irrespective of the name written on the check. Thus, there is a risk of making a payment to a wrong person. To avoid this risk, we cross out the word bearer on the check. Thus, only the person or party named in the check can encash it. Such a check is called an order check. The other type of check is a crossed check. A crossed check makes the payment straight to the payee's account. An ordinary check or a bearer check becomes a crossed check when 2 parallel cross lines are made on the left top corner of the check leaf as shown. The words account payee may or may not be written within these parallel lines. Such an indication on the check tells the bank that the said amount has to be credited to the payee's account and not be paid in cash across the counter. We have understood a lot about withdrawing money from a bank. Now let's focus on depositing money, which is equally important in banking. We can deposit money either in cash or a check through duly filled pay-in slip or through a bank draft or demand draft. To deposit cash or a check, we just need to fill up a pay-in slip form available at the bank and submit the same along with the cash or check. Information that needs to be filled in the paying slip includes the name of the account holder, the account number, the amount being deposited with correct denomination values in case of cash, the check details in case of a check, and the signature of the depositor. Another way of depositing money is through a bank draft or demand draft. It is an order issued by a bank to a specified branch of it to make a payment of a certain amount to the individual or organization specified on the draft. A person who wants to make a payment has to purchase a bank draft from the bank by paying a small service charge to the bank. The name of the payee and the amount to be paid is then specified on the draft. On receiving this draft, the payee can encash it by presenting it to that branch of the bank, which is specified on the draft. A draft also may be crossed, in which case the payee has to deposit the same to his bank account. When a savings account is opened with a bank, the account holder is provided with a passbook. This passbook is used to hold records of all transactions made between the account holder and the bank, such as deposits and withdrawals. A passbook maintains a table with 6 columns of details, which are the date of transaction, particulars of the transaction, the check number, the amount withdrawn, the amount deposited, and the balance after a particular transaction. An account holder should have his passbook updated regularly at the bank, or at least once in every half year on the 1st of July or the 1st of January, to have the addition of interest updated.